Hi, I am Nitin Shanbhag, Head of Investment Products. Welcome to this edition of India's Vision 2030. I have with me a very special guest. He is the Business Head and Chief Investment Officer at ASK Investment Managers, Mr. Prateek Agrawal. Prateek has an overall experience of over 25 years and he's been with ASK for over 10 years. And in his tenure, the investment strategy, style, and performance of ASK PMS and AIF strategies have moved from strength to strength. Welcome, Prateek. Thank you. So, Prateek, as a first step, while we are talking about India's decade, let's first touch upon what has happened in the previous decade, right? And there have been a plethora of opportunities that we have seen. In your investment style, which is largely growth oriented, we have seen that you tend to focus on high quality businesses which tend to give earnings growth in excess of 20% and ROC is typically in the range of 20 to 25%. How has that style really evolved over the last few years, especially during the pandemic?
Yeah, as a house, we were always focused on this high quality, high growth combination, hopefully available at some discount to valuation. So, you seek to make money through compounding of earnings and also as the valuation gap realizes itself. Uh, I would say over the journey, we have realized that for long-term investors, this is probably the only style that works. The cobwebs of other styles, we can do this and we can do that, have gone away. For a long-term investor, it is imperative that quality is there, quality of management, because it's not that the scenario is good all the while. Scenario, COVID was one, liquidity squeezes were others, and we have seen, high-flying businesses evaporate in those periods. So the focus on quality just intensifies. The second thing is quality alone is not sufficient. You can be a business making very high return on capital employed, for example, but it is growth that increases the value of your enterprise. And having a combination of quality and growth is difficult. This is something I think we realized early. Uh, I keep saying this. One, you are a business which is making more than others. Now, in a price sensitive market like India, it's not easy. Okay, and then while you are making more money, you are growing faster than others in the same space, which makes it more difficult, and not for 1 year but multiple years. So, in some sense, what you are left with is the rarest of rare corporations. And I think something that we have realized over the journey is, once you have found these, not to give away these quickly enough. So, I think for some of our portfolios, you would have seen the turnover ratios drop over a period of time. We have also come to appreciate that these are some of the best businesses the land has to offer. They hold well in bad periods, recognize their mistakes quickly enough, correct them, and hopefully not repeat them. So, they are doing what as fund managers we also teach ourselves to do, and thereby helping the cause. And we can recount several of these examples, where we have held and held, people have corrected mistakes and not repeated them and made humongous amount of money for investors. So I think that is how it is. Overall, yes, if we are quality and growth focused, quality stays consistent across whatever we do. But growth has to be more than the market itself, has to sustain for longer. That's the combination that typically makes the investor more money. And the outlook on various spaces in the markets change over a period of time. So I remember, in the when COVID hit, for example, we were pretty high on consumption names. Staples were 15 odd percent of that. So when I say consumption, it includes retail like Titan and Page, staples, consumer durables, etc. But staples themselves were 16, 17%. And then what has happened is, because in that period when it was being declared that we will open it up only when COVID goes away from the country, staples alone seem to be the space to be in. But as we understood that things will open up and open up for good gradually, but the direction is that we moved away from consumption from close to 50% overall and 17-18% in staples. Now staples would be 5 to 6%. Overall consumption is in mid-20s, mostly discretionary kind of spends, and other spaces which have like evolved. So if COVID happens and the habits change for good, versus watching, for example, OTT content, doing more on the net. So net-based businesses have suddenly come to the fore. And yes, IT services which enable them to do that. Some of these spaces were very less represented in our portfolios. They came in. I think COVID reinforced, the fact that we need to make more in the country. Manufacturing as a theme really came to the fore, and all the thoughts just got aligned. There is no if and then after that. Not only India, but I think the whole world started to recognize this. America coined this phrase, make America great again, which is basically make more in America. We were always saying that. So some of the manufacturing names came into the portfolio. Otherwise, you had seen manufacturing as a percentage of GDP just drop and drop. So if we were guys who were wanting faster growth, more growth, this was a space which was less represented, not represented, except maybe spaces like chemicals. That came back, yes, helped by PLI also, which all happened in the same period. And the China plus one kind of a theme, global supply chains who were trying to source from only one geography. Now, that is getting propped up as a risk factor. Internals would be telling them to source from at least two geographies, if not more. And in spaces, we look very good. Chemicals in particular, textiles, yes, APIs, yes. Of these spaces, I think what has come into the portfolio in greater strength is chemicals and APIs. So that's the change we have seen over a period of time, without losing sight on inherent quality of business, and like I said, longevity of growth, higher quantum and longer durability of growth.
Right. Indian entrepreneurs have created tremendous value over the last decade, and that is even reflected in your flagship strategy, which is the ASK Indian Entrepreneur Portfolio. The performance is close to 20% CAGR for the last 10 years. Now, how do you see these set of entrepreneurs doing in the next decade? What are the newer set of opportunities that you envisage?
So we have no doubt that entrepreneurs will do very well. I said once identified that these are best in the spaces that they are in. Many of the same names will probably continue to do very well. We are a country which is just about $2,000 per capita. If you go to a country like Thailand, which is $7,000 per capita, the point is this feels similar. So over this journey, lot of stuff that we are doing will be consumed more. So in lot of spaces, you may find that businesses that we have today may continue. Of course, they will change. We change a few, but there is a chance that some of them could continue for a very long period of time. And today, just to tell you, 50% of the portfolio is over actually 5 years old. Been that way, not changed, except for rebalancing. So some of the names I think will definitely survive. Uh, but you know, even for the best, if somebody is making a lot of money and for longer, competition would come up for sure, and that may again be from a good entrepreneur, for example. And at that point in time, if the competition is credible, it is also reinforced by a different, newer way of doing business. One would always evaluate. So, for example, over the COVID period, once again, a lot of these tech companies happened. Very few made our cut because they were not generating free cash flows. Some were, and we did look at them. Now, in spaces like finance, fintech is something which is really happening. Uh, Over past 10 years, let's say we have been with retail, SME, and smaller lenders, be it NBFCs, be it banks. Now, with a thought that value transfer was happening from the older generation of lenders, be it old private sector banks or the PSU banks, and these were entities who could do probably the same stuff slightly better, and hence were gaining market share in a sustainable manner over very long periods of time. Now, we have seen one fintech come in and make humongous amount of money trying to do business slightly differently with help of data, which is not your usual, Aadhaar and your tax data kind of stuff, but more to do with what kind of spends you are doing and hence what is your credit. I think as more of these businesses come in, even the earlier, so-called good long period compounding financials may face a challenge. And I think we should be open to judge one versus the other. The opportunity is large. India is a country wherein, for a housing loan you can get a rate like 6.5%, and there are sections in the country won't get a loan for even 35-40%. So the spectrum is large, and what we have started to appreciate is that each part can be pretty deep. It's not that the over 20% borrowers are shallow. You can build a great business there as well. So I think newer names will emerge, and they are emerging. So this is a portfolio that will be able to find some of those newer names, benefit, write the story with them. India is changing. Entrepreneurs are bringing the change. The good thing about policy making that you see today is that it is not like, you are a foreigner, you come and build in the country. While that is happening, we are seeing more number of newer people coming in, newer Indians coming in, listed in the country, who are building great businesses and wealth. PLI, while some may have gone to foreign only entities, most have gone to Indian entities with some latch up with a foreign name and so on, or maybe pure Indian entities. So, that helps. Make in India by Indians is something that creates the wealth in India. Otherwise, make in India by foreigners will create employment in India, but probably not wealth for investors. So I think even policy, it's a very judicious mix. What we can't do, we are getting others to do here. What we can do, where we can get technology, with some incentives, I think we are getting in Indian entrepreneurs to face it. Very good, I think, and that allows long period value creation. I think in an emerging country, policy is something that one should always be focused on. Uh, it helps today that globally every country recognizes the need to make more inside the country. Uh, Now, every country is not large. Every country most countries have very small populations. So if they do more inside the country, how will they get scale? You know, so earlier the thought was whole of Eurozone is one market and you can trade, whole of Africa one market and you can trade. But the thought today is every country in the zone may want to do something more, and it creates fragmented capacities. Well, India has over 135 crores of us. We are the second largest market. Along with China, at some point in time, we would be the two largest markets. So, the kind of scale that businesses can obtain in this country is unparalleled. And I made this point that many of the same businesses can continue, over this journey of 2,000 per capita to 6,000-7,000 per capita, and this journey will itself take 10 to 15 years. So that decade will be gone while this journey is being made. The scales that you will see will be very large. Meaning today in top 100, there would be very few Indian companies. Maybe 10 to 15 years hence, you should expect to see 15-20% of that 100 being built of Indian companies. There are not too many places in the world where 100 million ton cement capacity guy would be saying, I will get to 200 million tons in 7-8 years. And three other guys also aiming to cross the 100 million bucket. And this is an old industry, right? Similarly, in steel, we are 124 million. In 10 years, we would be over 200. Second largest producer, and once again in an old industry, growing at 7-8%. So that is, just to give you an example, while we are not there, very little there, but point is that industries which are done globally, saturated, are still seeing long period growth opportunity in this country. Newer businesses, of course, net based businesses we spoke of, fintech is a huge space. But at the same time, automobiles are getting disrupted. Electric vehicles, renewable energy are sources of very, very long period growth and strong value creation. In fact, hydrogen also, so which is where a lot of money can be invested with very, very visible kind of returns. What has also happened is that things which were not present in the country, a lot of that infrastructure has gotten built. So earlier, we had this model of, for example, a real estate guy building a residential house but selling it for money, and very little of the capital would be blocked there. While for a commercial building, office building, that building will sit on the balance sheet, and only the rentals would reflect there. So while the rentals could be good, 8-9%, but it would bring down the overall ROCEs of the business. Now there are structures like REITs, where once you get rentals in, you could offload that business into a REIT, and still, the cap rates are such, you'll still be freeing up your money and retaining 40-50% of the asset. Resulting in very, very strong churn of assets, and the same manner allowing the market to look at these businesses, value these businesses slightly differently. We have seen that happen. For example, earlier, let's say hotels were supposed to be very, very low ROC businesses, but now, well, these are theoretically REITable properties. All the road assets at one point in time clogged up the banks because of asset liability term mismatches. Now they are creating value for a lot of the developers. The cap rates at which these assets are being sold are 7-8%. So that's again something that's changed. It will get a bit tougher over the journey. Interest rates are moving up, but I think that should prove temporary. Over the next 3 to 4 years, chances are rates could be lower than where they are. This is something that I keep thinking about. If you look at the top six economies globally, the interest rates they offer are between 0 and 3%, and suddenly we offer over 7. So, very clearly, if inflation here seems to be similar there, if our currency is not anymore depreciating in the manner it used to in the past, chances are the interest rates will also converge. Throwing up a huge amount of valuation opportunities for our entrepreneurs. So, I think for people who are looking at India, policy making is supportive, scale is available. You will not end up with small scale businesses. You will be large if you can make it large in the country. And for valuations, the cap rates are important. They should also improve from where they are. So in many ways, I would believe scenario was never so good for entrepreneurs. And this is a space that can just keep doing well for long period of time. Names will change as they always will, but this portfolio of ours should always, the focus will always be on the best of names, the strongest and the longest growth stories and so on. So I think it has a great future.
Right. Now, taking the story of India forward in this decade, you already touched upon various different themes: urbanization, digitization, PLI, import substitution, so on and so forth. Which specific sector opportunities would you believe in? Can you talk us through some of these businesses?
So, there used to be a guy, Prahlad, who was talking of bottom of the pyramid, for example, and wealth at the bottom of the pyramid. That time, I must say, I was skeptical, but now businesses are finding that. See, one way of looking at the environment is what are your unmet needs? What are your new needs? Okay, and there are various sections of the population. What are their needs and the unmet ones? So the larger the need is, a good large business can be created to take care of that need. Earlier that was less possible, but now technology is making that possible in a very short period of time. So I think tech-based lending can be a very long success story. One would need to tread it carefully, but I have no doubts that it can be very long because the need is there. There is a very large section of Indians who don't have access to credit, and the credit at let's say over 25% is a crazy price to have credit. So it needs to also come down. And if the delivery is done in a manner that is cost effective, I think that can be brought down. So there are businesses which are attempting that. In the beginning, they will make a lot of money per unit of business. Over time, per unit of business, money would be reducing. Overall size of the business would increase. Clearly possible. Staying on the financial side, I think our industry, fund management, wealth management, has a great future. Provided, of course, we can maintain margins and pricing. Otherwise, it's a race down to zero. Now, as a percentage of GDP, mutual fund AUMs today, inclusive of all the EPFO money that comes in, is just 16%. For somebody who is a tad richer than us in terms of per capita, let's say Thailand or Malaysia, they are 7,000 per capita. Malaysia is higher, $10,000-12,000 per capita. Their mutual fund AUMs to GDP is 30 to 35%. Not to talk of developed markets where it is even higher. Now, if we get to these per capita over the next 10 to 15 years, uh, you know, from 37 odd billion dollars of AUM, we could go to something like 150, 160 billion dollars of AUM. And I think I am being conservative, it could be higher. So that's the growth that our industry will see, for example. And what you have to look at is when people get richer, what will they consume more, and from there you will have themes. So our industry clearly figures there. As did, let's say, automobiles at one point in time, as maybe the wearables, the air conditioning comfort providers do at this point in time. So as for example, so when I say comfort, it could be environment, air conditioning, etc. It could be comfort of home where things get delivered to you and people who deliver that. So lot of that would happen and create a humongous amount of value. Growth can be very strong because first you discover a need and then you are servicing it. Given the scale of India, it could just become very large. In fact, many of the traditional businesses also can become very large because how will a $2,000 per capita transform into a $7,000 per capita? It could mean that all members of the household work. For example, today one person is working, maybe it is getting divided by 4. If all work, then you are there automatically. But if all work, then who takes care of the house? Who does provide the food? And then suddenly, one would start to wonder what happens with the QSR kind of businesses. So many of the service providers could see very strong growth deep into the future. Needs change as people become more affluent, and that's a surer way of looking at the future. In this period, it's happened to, let's say, air conditioning, for example, and I think every one of us was watching when India crosses this $1,800, $1,900 per capita, and suddenly air conditioning becomes the key thing. So I think those things are definitely going to happen. As people get richer, first you want electricity. Electricity happens and there is joy. Then you want clean skies. At some juncture, it's probably happening to, let's say, China just now. They want clean skies, at least not dirtier skies, and they are willing to let go of a few businesses. Now, over the next 10 years that we are talking of, some of those businesses may be our opportunity. We spoke of chemicals, for example. We have the ecosystem, we have the knowledge base. Ecosystem in chemistry is extremely important because one guy is effluent is another guy is raw material. So if you want to do it cleanly enough, not too many people, not too many countries can do it. We have it, we will scale it up hopefully, and for a long period of time. So that is again something that should take place. Manufacturing, of course, high-tech manufacturing. Now, as of now, some initial seeds are being sown. But over time, very confident that if we become like 1/10 of the global market at some point in time, like over next 10 years, a lot of it will have to be manufactured here. Given the fact that high-tech manufacturing requires very little oil, material that we don't have, other stuff is all there. So that again is something that one should be looking at. Now, the other thing that does cross the mind in times like these is defense. We are amongst the largest importers of defense equipment. As something like a Russia-Ukraine shows, you can't be dependent on imports for fighting your war. I mean, Ukraine has Russian equipment. They can't be asking Russia for space just now, right? So I think it is crystal clear that you need to manufacture more of that stuff in the country. That opens up a humongously large opportunity, significant even for our larger caps, but for the mid cap space, very, very large kind of opportunity in terms of capabilities, newer metallurgy, newer chemistries, electronics, etc. A lot of them have are spin-off benefits. They may start with space and defense, but civilian applications can be really large. So I think the fact that every country will try to do more internally, the fact that we are amongst the largest, second largest importer of defense globally, and already doing hell of a lot internally. Point is, we can build something which will have scale, we can partner with people and provide them scale as well. For example, aircraft engines. A country like a smaller country does it. How many planes do they need? How many engines can they manufacture? They may have the technology. We may have the volumes. So all of those partnerships would be seen. Once again, I think there the policy framework has evolved quite a bit. We have stuff that people here will make. We have stuff that somebody from abroad will come and make here, and so on. So that again would offer a very, very long period growth. In fact, while I'm saying this, there is so much happening that I really start to think that the mid part of the market has a glorious 10 years in front of them. Whatever we have spoken about, PLI, beneficiaries of PLI, 100% lie in the mid-cap space. Larger caps, it's a small delta. Value transfer from one geography to the other, 100% in the mid-cap space. All chemicals, textiles, APIs, barring one or two are in the mid-cap space. Unorganized to organized, maybe one or two companies are large, a DMart or Titan may be large, but footwear companies, many other retail companies are all in the mid-cap space. So diagnostic chains, hospitals, just about happening, from being government run to now private sectors, increasing presence. So lots and lots of these are in the mid-cap space. 100% of fintech, barring the one listed one, is mid-cap space. I think journey would be long. It's not going to get over in 1 year. And the chance to make money over very long periods of time is something I believe is happening to India, and that is good. See, I was just thinking, if you grow very fast, you reach those middle income levels as an economy pretty quickly, and then suddenly you stagnate there. It becomes much more difficult. While at the pace we are doing, we would definitely want to make it faster, but if from 2000 to 7000 per capita takes us 15 years, for 15 years we have not reached middle income. and the growth prospects stay good, predictable, and humongous amounts of money is made over the journey.
Thank you so much, Prateek. It's been a fabulous experience just listening to you. And I'm sure all our listeners will take some very valuable insights from this. Thank you so much for listening in. Please do subscribe to our YouTube channel and please do also follow us on Twitter as well as LinkedIn. Thank you.